Earlier this week, the Fed opted to keep rates unchanged in a range of 0 to 0.25% and maintain its current pace of asset purchases at $120 billion per month, with total purchases now reaching $2.9 trillion since March. While optimistic the economy will eventually bounce back, potentially even later this year, in the statement, the committee did acknowledge that the pace of the recovery in terms of economic activity and employment has softened somewhat in recent months, noting that weakness was concentrated in the sectors most adversely affected by the pandemic. Essentially, at this point, with the pace of the recovery widely predicated on the pathway of the virus and progress on vaccinations, the Fed is attempting to walk a fine line, on the one hand justifying and assuring the market of its ongoing commitment to using its full range of potential tools to support the U.S. economy in this very challenging time, while on the other hand instilling optimism, or at least trying to instill optimism, for a future recovery and an economy that can eventually begin to withstand a withdrawal of monetary initiatives. It's a very delicate balance, painting a longer-term picture of a stronger economy while mindful not to incite a taper tantrum as former Chairman Ben Bernanke did in 2013. While inevitable at some point, for now, there has been no mention of tapering support, as the latest report shows the U.S. economy continues to struggle to recover from the pandemic. After all, also this week, fourth quarter GDP was reported at 4%. While there was seemingly enough strength in October and early November to carry the fourth quarter and remain in positive territory, even following a 31% increase in the third quarter, growth in the second half of the year was not enough to fully offset earlier weakness in the first half, leaving the U.S. with a 3.5% annual contraction, its first since the financial crisis. Now, going forward, depending on the depth and duration of the resurgence of the virus and associated policies, an even slower pace of growth or potentially a double dip back into negative territory is increasingly probable. At this point, there remain sizable barriers to activity ahead as businesses continue to struggle, resulting in reduced hiring and restrained spending, suggesting, rather than a V-shaped recovery, the economy is poised for either a 2 steps forward, 1 step back W-shaped recovery, with ongoing breakouts of the virus met with more ample restrictions, or more of a K-shaped rebound, marred by gains in some sectors, often to the detriment of others. In either case, with the vaccine rollout proving more difficult than expected, particularly as 50 states individually are responsible to develop, organize, and execute a distribution plan, already adding to delays in administering the vaccine to fewer than expected individuals, it appears the economy may face a bumpier, longer pathway back to some semblance of normal, resulting in potentially a more disappointing growth profile, as well as further support from both monetary and fiscal policy.